from your entry point to your stop loss, that is the determinant of your risk. This video is part of our Intro to Risk Management series. You can check out our full series on our YouTube playlist. The tools to help you better manage your trades, these are your stop loss and your take profit orders. So always remember to use them, and they are very important as part of your trading journey. They act as your guardians. Okay, so how these functions is that when you enter your trade, okay, you have the option to input your stop loss as well as your take profit orders. How it functions is that when the market price triggers, okay, either your stop loss or your take profit, the trade will automatically be closed for you. So that's how it functions. Okay, it works as a safety net, especially when you're not at your screen actively monitoring your trades, preparing to exit them. One of the key things is that regardless of strategy, trading plan, or your method of analysis to determine your entry points, the same method should also give you your exits. So for example, over here is that if you are using a common support and resistance method, your stop limits should generally be below your support for long positions. As for your shorts, all the short positions that you'll be taking, the stops are usually above your resistance levels. So over here we have a diagram, a chart over here where we marked out the trend channels for support as well as resistance. So let's say we identify a break over here, the break on the support level. And then after the confirmation, we decided that we want to have our entry point over here. For the stop loss, we will be setting it below the support, okay, the support level, as well as below the candle, as well as the shadow that broke the support level. So this is where we put our stop loss. As for take profit, there are several ways to do it. Okay, one of them being, as mentioned earlier, you can place it above your resistance level. So when it breaks, you can decide to exit your trade. Alternative methods is that you can adopt the risk-reward ratio method. Is that from your entry point to your stop loss, that is the determinant of your risk. So if your entry point to stop loss is, let's say, for example, 100 pips. If this is 100 pips, for a positive risk-reward ratio, let's say a healthy range of 1:2, you can put your take profit 200 pips, okay, above your entry point. In more advanced cases is that you can let your profits run and continue to let it accumulate. While doing so, while letting your profits run, is that you can capture your profits early by adopting the trailing stop loss method. Meaning to say is that while the market goes in your favor, in this case, if you are taking a long position, is that we want it to go higher, we want it to go up. When it actually moves upwards, you can shift your stop loss to your entry point. That way you capture the first threshold, you capture your first threshold of profits. So even in the worst case scenario that the market plunges, if the market plunges, you will still break even. Likewise is that if you continuously to shift it higher while the market continuously climbs, is that you will capture more profit along the way. So trailing stop loss is one of the methods that can be used as well. So this is how it will function. Risk-reward ratio. So what this is about balancing your potential gains against your potential losses. In most cases, you want to achieve a higher reward to every part of risk that you are utilizing. Meaning to say, for risk-reward ratio, you want to achieve maybe 1:2, maybe 1:3, or even in some cases higher than that will be ideal. But the key thing is that this is not in relevance to your winning ratio. In trading, you don't have to be right all the time. What this means is that you not necessarily have to always be correct. You don't always have to win. Winning is great, okay? Winning always feels good. However, okay, your winning percentage has nothing to do with your risk-reward ratio. You can have a lower winning percentage. However, with good risk-reward ratio management, you are still able to achieve a profitable account at the end of the day. So if I put it in an example, let's say you only have a winning ratio of 50%. You only win half of the time. However, with a very good risk-reward ratio is that every time you lose, you only lose 1, but however, when you win maybe 2 or maybe even you win 3. Over the course of time, with a good risk-reward ratio like that, you will still end up with a good and profitable account. That's what it means to be. You don't have to be right all the time, right? With a good risk-reward ratio, you can still achieve good profits at the end of the day, right? So to close off, we have a quick summary over here is that risk management is key for you to stay in the lane, stay in the financial markets for the long run, right? Always think in terms of relative percentages when performing your risk tolerance and managing your risk. Always have risk thresholds for yourself, be it on each trade or an account as a whole. Right, so we have once again the example over here is that if I wish to do 1% on each trade, I should be consistent about it as well. But as a whole, total exposure on account perspective is that I want to keep within 10% of my total risk exposure at any given time. Meaning to say, if I risk 1% on each trade, I should be able to hold up to 10 trades running at any point, like as a form of maximum total risk exposure. So exits are just as important as your entries, and we cannot stress this enough. Regardless of your strategies, whatever strategy that you may be using for your analysis to determine your entries should also give you your exit points to mark out your stop loss as well as your take profits. It's important to diversify your trades, alright? Focus on risk and reward. Okay, so earlier as mentioned is that risk reward has nothing to do with your winning percentages. You can have a low winning percentage, but with good risk reward, you will still be able to achieve a profitable account at the end of the day. So this sums up the risk management for financial trading. So once again, thank you, and we'll see you next time. That's all for this video. Thank you for watching. You can check out the rest of our playlists on our YouTube Intro to Risk Management playlist. If you want to learn more about trading fast, trading smart, head to Mitrade Academy where we'll deep dive into the world of trading.